For 5 decades, the petrodollar system has been the bedrock of American global economic dominance. It is the silent, invisible mechanism that has allowed the United States to finance its massive deficits, maintain low inflation, and project unparalleled geopolitical power. But the unthinkable is now being whispered in the halls of power, from Beijing to Riyadh, from Moscow to Brasilia. The petrodollar is dying, and the year 2025 is emerging as a critical inflection point. This is not a conspiracy theory. It is a complex, multifaceted geopolitical and economic reality unfolding before our eyes. The question is no longer if the system will change, but when and what will replace it. The death of the petrodollar is not merely an economic event. It is the harbinger of a new world order. The implications for global finance, trade, and the average American's wallet are staggering, promising a decade of unprecedented volatility and realignment. To understand the magnitude of this shift, we must first revisit the system's genesis and its intricate mechanics. The petrodollar was born from a crisis and a handshake. In the early 1970s, the Bretton Woods system, which pegged the US dollar to gold at a fixed rate, collapsed under the strain of US fiscal policy and the Vietnam War. President Nixon's decision in 1971 to unilaterally end the dollar's convertibility to gold, the Nixon shock, left the dollar suddenly vulnerable and unbacked. Simultaneously, the 1973 oil crisis, triggered by the Yom Kippur War, demonstrated the immense strategic power of oil-producing nations, particularly OPEC. The US needed a new anchor for the dollar. In 1974, US Secretary of State Henry Kissinger and Treasury Secretary William Simon brokered a landmark, secret deal with Saudi Arabia, the de facto leader of OPEC. The agreement was simple yet revolutionary, establishing a 2-pillar system. 1. Oil pricing in dollars. Saudi Arabia would price all its oil exports exclusively in US dollars. In return, the US guaranteed the security of the Saudi monarchy and provided advanced military equipment. 2. Petrodollar recycling. Saudi Arabia would invest its massive surplus oil revenues, the dollars earned from oil sales, into US Treasury securities and other dollar-denominated assets. This mechanism created a perpetual motion machine for US economic power, known as petrodollar recycling. Every nation that needed oil, which is every industrial and developing nation, had to first acquire US dollars, creating a massive artificial global demand for the dollar. This demand was independent of the US's own economic performance. The dollars then flowed back to the US financial system through the purchase of treasuries, effectively financing the US national debt at low interest rates. This allowed the US to run persistent trade deficits without a corresponding currency collapse, a privilege no other nation enjoyed. This exorbitant privilege became the foundation of the post-war American century, enabling global military projection and economic stability at home. The system ensured that the dollar remained the world's primary reserve currency, the unit of account for global trade, and the main medium of exchange for international finance. The system, however, was never designed to last forever, and the cracks have become undeniable. The primary drivers of the petrodollar's decline are a confluence of American overreach, the rise of determined geopolitical rivals, and fundamental shifts in global trade dynamics. First, the weaponization of finance. The US has increasingly used the dollar's dominance and its control over the global SWIFT payment system as a tool of foreign policy, imposing sweeping sanctions on nations like Iran, Russia, Venezuela, and even threatening allies. The freezing of Russia's $300 billion in foreign reserves following the 2022 invasion of Ukraine was a watershed moment. It sent a clear, chilling message to every central bank in the world. Holding US dollar assets is a geopolitical risk, and your reserves can be seized overnight. This action, more than any other, accelerated the global search for alternatives to insulate national economies from potential US coercion. Nations are now prioritizing economic sovereignty over financial convenience. Second, the rise of BRICS and de-dollarization efforts. The BRICS bloc, Brazil, Russia, India, China, and South Africa, is expanding and explicitly positioning itself as an alternative to the Western-led financial order. The expansion to include major oil producers like Saudi Arabia, the UAE, Iran, and key economies like Egypt and Ethiopia is a direct existential challenge to the petrodollar. These nations represent over 40% of the world's population and a significant portion of global GDP. Their stated goal is to create a new trade settlement mechanism, potentially a common currency or a basket of currencies, to facilitate trade in local currencies. China, in particular, has been aggressively promoting the use of the yuan for oil purchases, signing major deals with countries like Russia and France. When the largest oil exporters agreed to accept non-dollar payments, the petrodollar's core function, forcing the world to hold dollars for oil, is fundamentally undermined. Third, the US debt crisis and fiscal erosion. The sheer scale of the US national debt, now exceeding $34 trillion and growing by trillions annually, is eroding global confidence in the dollar's long-term stability. The persistent, massive budget deficits, coupled with political brinkmanship over the debt ceiling, suggest a lack of fiscal discipline. Foreign creditors, particularly China and Japan, have been steadily reducing their holdings of US treasuries, signaling a loss of appetite for financing American debt. The dollar's value is ultimately backed by the faith and credit of the US government, and that faith is being tested by what many international observers perceive as reckless and unsustainable fiscal policy. The risk of a major sovereign debt crisis or a loss of reserve status is no longer a theoretical possibility, but a growing concern. Fourth, technological disruption, CBDCs and blockchain. The emergence of central bank digital currencies and distributed ledger technology offers nations a path to bypass the traditional dollar-centric SWIFT system. A CBDC, such as China's digital yuan, allows for instant, final, and direct cross-border payments without the need for intermediary banks or dollar conversion. This technological leap provides a viable, non-dollar alternative for trade settlement, accelerating the shift away from the US-controlled financial infrastructure. While the US Federal Reserve is exploring a digital dollar, other nations are far ahead in implementation, creating a new digital frontier for de-dollarization. The year 2025 is not a hard deadline for the petrodollar's complete collapse, but a symbolic and practical convergence of several critical factors that suggest an acceleration of the de-dollarization trend, marking the point of no return. The Saudi-US Security Pact re-evaluation. The original 1974 agreement with Saudi Arabia, the cornerstone of the petrodollar, was a 50-year pact. The 50-year anniversary falls in 2024 to 2025. While the exact terms of renewal are often shrouded in secrecy, Saudi Arabia's recent actions speak volumes. The kingdom's decision to join BRICS Plus, its open discussion of accepting non-dollar payments for oil, and its aggressive pursuit of its national interest under Vision 2030, which aims to diversify its economy away from oil and US reliance, suggest a fundamental re-evaluation of its relationship with the US. Any renewal of the pact will likely come with significantly altered terms that dilute the dollar's exclusivity, perhaps allowing for a percentage of oil sales to be settled in other currencies. This single change would remove the core pillar of the petrodollar system: BRICS institutionalization and currency progress. The BRICS nations have set an ambitious timeline for developing a common trade settlement mechanism, potentially a new currency or a basket of currencies, with significant progress expected by 2025. The new development bank, the BRICS multilateral financial institution, is actively working to increase the share of local currency financing in its portfolio. By 2025, the NDB aims to have 30% of its lending in local currencies, a clear move to bypass the dollar. Furthermore, the political momentum behind BRICS, driven by the desire for a more equitable global financial system, suggests that 2025 will see the launch of concrete, functional alternatives to dollar-based trade. The US political and fiscal cycle. The political landscape in the US following the 2024 election and the subsequent fiscal debates will likely solidify the global perception of American stability. Continued political polarization and failure to address the spiraling national debt will only accelerate the flight from dollar assets. The year 2025 will be the first full year where the consequences of the new political cycle are felt globally, influencing central bank decisions on reserve diversification. The death of the petrodollar will have profound and painful consequences for the American economy and its global standing, marking the end of the exorbitant privilege. Inflationary shock and higher interest rates. The artificial, non-economic demand for the dollar will vanish. This means the US will no longer be able to export its inflation by having other nations absorb excess dollars. The dollar will weaken, making imports significantly more expensive, leading to a sharp rise in domestic inflation. Simultaneously, the US government will have to pay significantly higher interest rates to attract buyers for its massive debt, as foreign central banks reduce their treasury holdings. This could lead to a vicious cycle. Higher interest payments crowd out other government spending, further straining the budget and potentially leading to a sovereign debt crisis. The cost of borrowing for businesses and consumers will soar, triggering a deep and prolonged recession. Loss of geopolitical and military leverage. The ability to impose sanctions, freeze assets, and control global financial flows is directly tied to the dollar's reserve status. As nations move away from the dollar, this leverage will diminish, severely limiting the US's ability to influence global events through economic coercion. The US military presence, which has been partially financed by the petrodollar's ability to keep borrowing costs low, will become significantly more expensive to maintain, potentially forcing a reduction in global commitments. The world will become less responsive to American foreign policy demands. Capital flight and deindustrialization. A weakening dollar and rising interest rates could trigger massive capital flight from US financial markets. Foreign direct investment could slow, and multinational corporations might shift their headquarters and manufacturing bases to regions with more stable and less weaponized currencies. This deindustrialization trend would exacerbate domestic unemployment and further depress the American standard of living. The world that emerges from the petrodollar's shadow will be multipolar, complex, and volatile, characterized by diversification and a return to hard assets. A basket of currencies and SDRs. The most likely scenario is not the replacement of the dollar by a single currency, but its replacement by a basket of currencies used for trade settlement. This could include the Chinese yuan, the euro, the Japanese yen, and potentially a new BRICS-backed unit. The International Monetary Fund's special drawing rights, which are already a basket of major currencies, could gain prominence as a neutral unit of account. This diversification will make the global financial system more resilient to the actions of any single nation, but also more fragmented and less predictable for traders and investors. The return of gold and commodities. Gold, which has historically served as a neutral reserve asset, is already seeing a resurgence. Central banks, particularly those in BRICS nations and emerging markets, have been aggressively accumulating gold reserves at record pace, signaling a return to hard assets as a hedge against fiat currency instability and geopolitical risk. Furthermore, we will see a significant increase in bilateral trade agreements where commodities are exchanged directly for local currencies, bypassing the dollar entirely. For example, oil for yuan, natural gas for rupees, or grain for Brazilian real. This is a return to a more fundamental form of trade, driven by real goods rather than financial instruments. The digital frontier and MCBDCs. Central bank digital currencies will play a crucial role, particularly in cross-border payments. The development of multi-CBDC platforms, which allow different national CBDCs to interoperate, will create a seamless, non-dollar alternative for international transactions. China's digital yuan and the development of projects like the BIS's Project mBridge are pioneering this new digital infrastructure, accelerating the shift away from the US-controlled financial plumbing. Investment implications for the average person. The death of the petrodollar is not just a concern for central bankers and geopolitical strategists. It has direct, tangible consequences for the average investor and consumer. The primary shift is the need to move away from a purely dollar-centric investment strategy. Diversification becomes paramount. Investors should consider increasing their exposure to assets that historically perform well during periods of dollar weakness and high inflation. This includes physical, gold, and silver, which serve as traditional hedges against fiat currency debasement. Furthermore, exposure to commodity-producing nations and their currencies, particularly those in the BRICS Plus bloc, offers a way to benefit from the shift in global trade flows. This means looking beyond the S&P 500 and exploring international equity markets. Finally, real assets like real estate and infrastructure can provide a hedge against inflation, as their values tend to rise with the cost of living. The key takeaway is simple. The era of easy money and dollar dominance is ending, and a defensive, globally diversified portfolio is the best defense. The transition away from the petrodollar will be turbulent, marking the most significant shift in global finance since the end of Bretton Woods. It will challenge the established order and create immense volatility in financial markets. For investors, this means a fundamental re-evaluation of asset allocation, prioritizing real assets, maintaining exposure to the emerging economies that are driving this change, and hedging against dollar weakness. For the United States, it is a critical call to action. To address its crippling fiscal imbalances, restore global trust through responsible foreign policy, and adapt to a world where its economic power is no longer guaranteed by a 50-year-old oil deal. The petrodollar is dying, and the new financial world is being born. The year 2025 marks the beginning of this great, inevitable transition, and those who prepare now will be best positioned to thrive in the multipolar era.